Hi everyone, my name is John Locke and I'd like to welcome you to The Winning Trade, but first the required disclaimer material. This presentation is given for educational purposes only. We're not broker-dealers or financial advisors and we're not making any specific trade recommendations. Also, please be aware that your risk in trading options is substantial and please make sure you are aware of all your risks prior to placing any trades. Also note that in this presentation we are covering hypothetical computer simulated trades and/or results. They're believed to be as accurately represented as possible, but keep in mind that live results can vary from simulated results for many different reasons. If this is your first experience with us, my name is John Locke. I'm a trading performance and success coach with Locke in Your Success LLC, where my team and myself are here to help you win in the markets and in life as well. Now in a moment we'll be going over the winning trade, but before I do, I'd like to explain to you what I mean by an income or high probability trading strategy. An income strategy is where we put ourselves in the position to generate profits through the passage of time rather than depending solely on price movement to move in our direction in order to make money. Now this doesn't mean we're going to make money all the time, but it does mean that we're in a much better situation or a much higher probability of making that happen. Now when you find that you want more information as you're following along, simply contact us at lockeinyoursuccess.com. That's L-O-C-K-E inyoursuccess.com, or ask a question in the comments on this video and we can direct you to where you can find more information. Now the winning trade we're going to be talking about today is called the Bearish Butterfly. It is one of three primary trading structures that we utilize in the Locke trading system. Now this trade is designed to take advantage of a variety of market conditions, such as overextended uptrending markets, downtrending markets, and sideways trending markets, which is pretty much most of the time. Now this trade is going to require a minimum capital of $5,000 per trade, but our example size today is going to be quite a bit larger than that. It's going to be $50,000. The profit target on this strategy is 30% of what we call planned capital. In this case, the planned capital is $50,000, so 30% of that is $15,000. The trade also has what we call a reduced profit target of 10%, or $5,000 should the trade get to 21 days to expiration and we have not yet hit our profit target. Now the exit loss trigger on this position is going to also be 30% of planned capital or $15,000. So it's a relatively large position. Obviously if you're new to this, you should be trading smaller position sizes. All right, so let's take a look at the position. So before we get started, this software here is an analytical software that we call OptionNet Explorer. And for those of you who may not be familiar with this, we have the strikes of our options on the left here. We have our call options, and this is each strike. Our put options, this is each strike. This tells us our mid price of our options, our implied volatility, and the delta of the individual option. And these across the top are our available expiration months. So we have a August, a September, and October that's shown here. The trade we're going to be doing today is going to be entered 56 days to expiration, so we're going to use the September expiration month. And again, the date here is going to be July 24th, 2020. So when we enter this position, we're going to sell an iron butterfly. So when we do that, the iron butterfly is going to be about 20 points below the asset price. So this is showing our asset price of $14.66. If we go about 20 points under that, we're looking at $14.40. So we're going to sell our short strikes of our iron butterfly at $14.40. We're going to put in 50-point wings, and we're going to buy some $14.90 calls and some $13.90 puts. That's going to give us a position on an analytical graph that looks like this. So the triangle shaped line is what's called our expiration graph, and this shows us the value of the position at expiration at any given asset price. So the Russell asset price goes along the bottom, and the profit and loss goes up and down the side here. And so for example, if this were to, if you were to run this trade to expiration, which would be, we're generally not going to do, and the asset price is at exactly $14.40, then we would be making just under $45,000. If it was way out here, we'd be losing about $5,000. Now, As I said before, this is a $50,000 position, so as we go along, more capital is going to be put into the trade, or at least most of the time that it is, and our planned capital is going to be $50,000. So we only have a very small amount of capital on it at this point. I should also explain the T plus 0 line. This curved line here is called the T plus 0 line, or the value of this position as of today at any given price point. This is a projected value, but it's generally fairly close to reality. And we can add other lines in if we'd like to see how the position value should change over time, or at least the way the model's predicting the value to change over time. For now, we are only going to use one line, and we'll see how this goes. Now, this strategy is a bearish bias strategy. In other words, we generally would like a sideways to bearish market, but it can work quite well with an up move, as you'll see with this presentation. So what we're going to do is, if we get an up move, in other words, the price moves in this direction to the right, then we're going to add in more butterflies. We're going to add up to 3 what we call tranches of butterflies. So we have 10 butterflies on now. If the price goes to, we have our short strikes here at 1440. So if the market goes to 1480, we're going to add some more butterflies in. If it goes to 1500, we're going to add more, and then we'll be what we call fully scaled in. We will add up to 3 tranches. After which, as the asset price goes up, we're going to take the lower butterflies and move them higher. And that's a process called rolling. So we might, if the price goes up, we might roll this 1440 butterfly to say 1460 or something like that. Now, to the downside, we are going to, if we run into a problem to the downside, we'll be rolling this position back. So we'll take this, say we got down to 1350, for example, and this starts taking on pressure to the downside. We're going to take this off. We're going to move it back to at the money. So that's essentially what we're doing in short and simple terms. So let's take a look at this and see how this goes. It's July 24th. I'm just going to go to the next adjustment. And it doesn't take long. It only takes 1 day. So we immediately get an up move after we enter our position here, and that hit a trigger to what we call add in the second tranche or the second third of the position. So that being the case, and our trigger point too is 1480, by the way. So that being the case, we're going to add more butterflies in. So we come in and we sell some iron butterflies here at 1460 short strikes, and now we're 2/3 scaled in. So let's go to our next adjustment, which is only 2 days later. So the market at this point is moving up fairly quickly. In fact, if we look at our price chart here, you can see we entered, way down, at this little bottom here, and we went up the next day. We got 2/3 scaled in. We came down the following day, and then we went up and broke out higher the next day, and now we are 3/3 scaled in. Now from here, ideally, what we would like to see is we would like to see the Russell back off. In other words, we'd like to see it have a normal cycle, maybe back off 60, 70, 80 points. Now, the good thing is we're scaled into this position. We only have like 15,000 in it. If the market behaves at this point and either ranges in this position here or decides to drift back here, this will very quickly get up to a $15,000 profit target. And those trades, when they happen, are absolutely beautiful. So we really like it when that happens. That did not happen here. So let's just go to the next day here, or the next adjustment. And we go to October 4th, and the market continues to rise. So now, right now, we have butterflies at, and I'll just use the put strikes for a reference, even though these calls are at the same strikes, these short calls. We have butterflies at 1440, 1460, and 1480 short strikes. We had this up move. You can see we're running outside the tent. Our profit and loss isn't doing bad, right? We have a $15,000 maximum loss, and that's certainly not terrible. So, but we do have to make an adjustment. In this case here, we had to make a roll. So instead 40 is our lowest strike, we now have 1460, 1480, and we rolled the original 1440 up to 1500. And this is our new position. Still not bad. We would like to see the market pull back at this point. Again, it doesn't take long once the market settles to get your profit in this thing. But that doesn't happen here. So let me go to next adjustment. Very next day, we get up another 27 points. So this being the case, we have more adjustments to make. You can see we kind of flew outside the position here. We're currently in 1460, 1480, 1500s. We're going to completely remove that position because of the speed at which we moved, and we're going to 1520, 1540, 1560. So we're just keeping up with the market at this point. Now, this adjustment is still okay. We're down $3,300, which is, it's getting a little bit higher, but still, again, a $15,000 maximum loss. We're not even a third of the way there. And to the downside, we still look pretty good. It would take a pretty severe down move to hurt us to the downside at this point. So if we go to the next adjustment, that's August 10th. And we have the same challenge, right? We have the same challenge. The market is just continuing to go higher and higher and higher. So this is the positioning we're in. Let's just take a look at the price chart. So we started out down here, and we had a pretty aggressive breakout here. If we take a look at our current positioning, we're way out here again. And as the market goes up, this actually starts to roll faster and faster to try and stay on top or stay with the marketplace. We're down 6,200, a little more than a third of our maximum loss. Not really a big deal, but we are due for an adjustment here. We're currently at 1520, 1540, 1560s. We end up rolling two sets of butterflies. We end up rolling the 1440s and the 1540s and the 1520s up to 1580 and 1600. This is our new position. We're down $6,400. I don't like this positioning so much now because now we're getting to the point where the market's gone up so much where we could have a little bit of stress on our position here if we do get a downside move. But we're going to hang in there. We're still well from our maximum loss. Let's see how this goes. What I'm like to do here is start to go day by day. So we settled in here. Let's just go a couple days, 3 days. See, within 3 days, this is already coming back. One of the things about this positioning is it's rather large, and the profit and loss comes back to this very, very quickly when the market stalls, typically. So we're doing okay here. We're coming back. Let me go next day. Finally, the market's settling down a bit here. And we're back to nearly break even now, only $1,600. Let's go to the 18th. We're finally positive. We'll just kind of click day by day here. Now we're 28 days to expiration. Remember, we lower our profit target when we get to 21 days to expiration to $5,000. Right now, we're at $3,800 approximately profit and loss. So this is going fairly well. Now, if we get too far outside this tent here, we're going to start pulling the upper butterflies back off again and getting our position size back down. But and then, of course, if we go up too far, we'll be making some more rolls. But right here, it looks like the market settled in and the money's coming back really fast. Let's go to the 24th. Now we're up $5,000 here, and the asset price is at $15.62. This is looking nice. 25th, we're up $5,500. On the 26th, we're up $6,049. Back down to 5,100 on the 27th due to this up move here and an implied volatility shift that wasn't exactly in our favor. And then if we go to Friday, I'm going to ignore the trades. Friday is 21 days to expiration. As long as we're over this $5,000 profit and loss at 21 days to expiration, the position is coming off. So let's go to the following day. And we are up $7,349. Our reduced profit target's 5,000. This position is closed out for a profit of about $7,200, which is very good considering the fact that we literally, if you take a look at the size of the move that we had in the market when we put this trade on, remember this is a bearishly profiled position. The Russell went up 150 points after we got in, and drawdown only got to maybe a little bit more than a third to maximum loss, and then we sat in the position, let the time and theta decay do its thing, and hit our profit target relatively easily in about 35 days. And that is why I love the bearish butterfly. We had a bearishly positioned strategy. We had an up move of 150 points in the index, and we still made 14.5% in 35 days. To me, that's just simply awesome. So for more information on the bearish butterfly, simply go to lockeinyoursuccess.com. That's LOCKE inyoursuccess.com. Go ahead over into trading courses and take a look at options trading strategies. Scroll on down to the bearish butterfly and you can click there, and this gives you a whole bunch of information on the bearish butterfly. You can also go over to thewinningtrade.com and you can check out all the past episodes of the bearish butterfly on the winning trade. It's simply an awesome strategy for anyone wanting to produce income through trading. If you like what you see, I encourage you to join us and discover how you too can follow along with this and many other great strategies as they unfold during our weekly Options Trading for Income webinars, and where you can also learn about upcoming winning trade presentations and our Trading Success Blueprint. And perhaps best of all, you can get free information about our free Trading Performance podcast, where you can learn to become a much more effective trader regardless of the type of trading you do. If you have any questions or comments or anything you'd like to see on the next winning trade, we'd love to hear from you. Simply comment on the video below so we can get those answered for you. And we'd also encourage you to come on over to thewinningtrade.com. That's thewinningtrade.com, where you can find past episodes of The Winning Trade, as well as a lot of other fantastic information on how to profit through income trading. And please remember to subscribe and comment on our YouTube channel, where I will personally answer any question you may have. Thank you, and we'll see you on the next winning trade.